Hey guys, what's up? I'm Erin and welcome back to Erin Talks Money. So what are the biggest factors that affect your portfolio's growth? One is your time in the market and two is your rate of return. So the longer you're in the market, the longer compound interest has to work its magic and grow your money. And obviously, the higher the rate of return you earn, the more your money is going to grow. It's far superior to be getting a 10% annual rate of return for 40 years versus getting a 6% annual return for just 20 years. Again, obviously. But what if I just said that there are 3 simple things you could do to boost your annual average return by about 3%? Well, first off, you may be wondering just how much does an extra 3% per year make on your portfolio anyhow? Well, over the course of a 40-year career, it can make a massive difference in your overall net worth. So let's throw some numbers into the mix and see what I mean. Let's say you invest $10,000, let it grow for 40 years at an annual rate of 6%. It would grow to about $1.6 million. However, if you took that exact same $10,000, left it invested for 40 years, but this time at a 9% annual rate of return, it would grow to $3.7 million. That 3% greater rate of return more than doubled your nest egg. Just to put rates of return into perspective, what if we ran these numbers again, but this time with just a 1% greater rate of return? So with 7% instead of 6%. Well, this time your portfolio would grow to $2.1 million. So just a 1% increase in your rate of return increased your nest egg by 31%. Rates of return matter, even if we're just talking about a percent or so. So if there were small things that you can do to actually increase your annual rate of return, you should absolutely do them. But the good news is that there are, and I have 3 of them for you today. If done together, they can increase your annual average return by about 3%. The very first thing you can do is to invest in mutual funds that have very low fees. These are generally going to be index funds. Mutual funds have what is called an expense ratio, and that is the fee charged to you by the brokerage house for the ability to use this fund, the ability just to put your money in this fund. And this fee is charged to you regardless of how the fund performs. So whether it goes up, down, or sideways, you still have to pay this expense ratio. Now, it is in your best interest to keep this expense ratio as low as possible. I know in life we often have that feeling of you get what you pay for, but that's not the case with mutual funds. Paying a higher expense ratio does not guarantee a better fund performance. It only guarantees that it's going to eat into your profits. So the industry average for an actively managed fund is about 1.2%, but it can go all the way up to 2%. However, if you were to choose a passively managed index fund like the Vanguard Total Stock Market Fund, you would be looking at an expense ratio of about 0.04%. Or you could go with Fidelity's Zero Total Stock Market Fund and literally face an expense ratio of 0. That's right, they literally charge 0 as an expense fee, and no fees really are the best fees. So by simply choosing passively managed index funds over actively managed mutual funds, you can boost your annual return anywhere from 1 to 2%. That's a big deal. So let's throw some numbers into the mix and see how this would affect your portfolio. So if we compared Vanguard's Total Stock Market Index Fund with a 0.04 expense ratio and an actively managed fund with the industry standard of a 1.2 annual expense ratio, and we did that for a fund going over the course of a 40-year career, you would save yourself over $400,000 in fees. It's a no-brainer. Choose the index fund. Next, you want to choose a fund that has very low turnover, and turnover refers to how often a fund buys or sells holdings. Now, turnover is kind of a hidden fee because it's not directly disclosed to you and it's not directly charged to you as an investor, but make no mistake about it, it absolutely affects the performance of your fund. Every time a fund manager buys or sells holdings, there are costs associated with that. There are brokerage commissions. There are also costs associated between the difference between the bid price and the ask price of a stock. So the higher the fund turnover, the more cost the fund is going to face. The lower the fund turnover, the less cost that the fund faces and the more profits you get to keep as an investor. And while the costs associated with turnover are not directly disclosed to you as an investor, the rate of turnover for the fund is, and it is stated as a percentage of the holdings that are bought and sold over the course of a year for the fund. Now, if every single holding was sold throughout the course of a year and changed to something new for the fund, that fund would have 100% turnover. The industry average for an actively managed fund is to have an annual fund turnover of about 89%. If that seems high, it's because it is, but those managers have to have something to do all day, and make no mistake about it, they are, and it's costing you money. If you compared that to the Vanguard Total Stock Market Index Fund, which has a turnover rate of about 4.1%, or to the Fidelity Zero Total Stock Market Fund, they only have a turnover rate of 6%. And it's not surprising that index funds have the lowest rates of turnover. They don't have an active manager tinkering with their holdings every single day. Instead, they simply track an index. Now, studies have shown that having a low turnover fund can actually boost the fund's annual performance by about 1.44%. That can often be higher than the fund's expense ratio, so that's a big deal. Now, ideally, you want to be in a fund that has turnover of about 20% or less. Index funds make a great choice because their turnover tends to be around 5%. And finally, you want to rebalance your portfolio annually. So that means you are buying low and selling high. And rebalancing just means sticking with your chosen asset allocation. For example, if you chose a portfolio that was 85% stocks, 10% bonds, and 5% cash, inevitably, as time goes on and the markets move up and down, your portfolio will fall out of balance. Now, when you select a date annually to rebalance your portfolio, you are doing so to stick with your investment strategy, not based on emotion or a simple reaction to market performance. So let's say that you had that previously stated portfolio structure. After a year's time, say that your bonds were 15% of your portfolio, cash was still 5%, and now your stocks were only 80%. In this case, you would sell off 5% of your bonds and put that 5% towards stocks. So in this sense, you are buying low and selling high because the stocks have underperformed, so you're buying them when they're down, and you're selling your bonds which have outperformed, so selling high. Now, the research here actually tends to be a little mixed. Some research suggests that rebalancing your portfolio annually can actually increase your fund's performance by about 0.5% all the way up to a full percent every single year. However, other studies suggest that it can actually reduce your overall performance because you're most likely selling stocks which tend to be the biggest movers and in favor of buying lower performing asset classes like bonds or cash. So as I said, the research here is mixed and likely it's going to depend on your individual situation and your holdings. But I do want to make a case for rebalancing your portfolio at least annually because it does help keep your portfolio at your intended and selected risk level. As you age, you are likely not going to want to have a portfolio that is 100% stocks. You want to have a balanced, more well-rounded, more robust portfolio. So you're likely going to want to have some exposure to bond funds, some exposure to real estate investment trust, REITs, and the like. So adding diversity to your portfolio can actually help make for a more robust portfolio. If left unchecked and left to its own devices, stocks can easily overtake an entire portfolio. Without any sort of rebalancing, stocks could easily make up greater than 95% of your portfolio, and that will certainly make for a more volatile ride because the stock market definitely has its ups and downs, as we have seen in 2020. So rebalancing your portfolio can make for a less turbulent ride, and it can help you stick with your investment strategy and stay invested long term. You need to stay in the market. But if your portfolio performance is so turbulent that it causes you a heart attack or sleepless nights, you're not going to want to stay invested. So rebalancing helps keep you at your anticipated risk level, and it keeps you invested long term. So rebalancing is still a good idea. So there you have it. 3 things you can do to boost your annual performance of your portfolio. Stick with low-cost funds, Stick with funds that have a low turnover and rebalance, so you make sure to stay the course. Do all of these 3 things and you could actually boost your average annual return by about 3%. You can accomplish the first 2 simply by choosing index funds. As for the third, you're just going to want to select one date every single year to go over your holdings and make sure they're still in line with your current risk tolerance. I post new videos every Monday and Thursday, so I will see you very soon, guys. If you liked this video, please give it a thumbs up on the way out. If you know a friend who could benefit from this type of content, please consider sharing. Also, if you're new here, make sure to ring that subscribe bell, and I will see you soon. Bye.